webinar. I'll be your host for today. My name is Josh Elohim. Company's BackNine Insurance. We are a boutique general agency, and we focus on life insurance, long-term care, annuities, and disability income. Just some quick notes here. Everyone will be muted for the presentation. If you do have questions, you can either send me an email. All my information will be at the end of the presentation, as well as give me a phone call, just so we can have this be a smooth presentation here. Without any further ado, kick off your shoes and let's have some quick fun here. Quick disclosure. I'm sure everyone will read this very quickly here. And let's go ahead and get started here. So what is COLI? COLI is corporate-owned life insurance, which has been around for a long time. Some of the history of COLI goes back to the 1950s, where it was used for a tax arbitrage. In the 1980s, it was used for tax shelters. And then moving up to the 1990s here, it was used for tax deferrals. Now, see, in the past, this was reserved only for Fortune 500 companies. The top executives of the top companies, this is who this product was available for. And what had happened was they realized that there's only 500 Fortune 500 companies. So from 2010 till present, what they've done is they've lowered the amount of lives that were needed in the past, because it was a tremendous amount before, down to 10 lives. So now this is available for the small to mid-sized business space. I've had a lot of success in this space working with property casualty firms, employee benefit firms, and anyone that has access to small to mid-sized business owners. And the success I'm having is retirement income plays and also balance sheet plays, which we will go over in our presentation today. These plans are extremely customizable. They're predictable, flexible, and versatile. There's several different ways that these policies can be owned, whether it be company-owned or company-sponsored and individually owned. Some of the key things that this helps with the business owners is to attract, retain, and reward their top performers. So the C-level and above, the executives, people who are doing really well, it's a great tool in this space here. Some of the things, as you see in our chart here, that it provides is protection for the company, continuity for the company. Retirement plans is becoming very important. How can we set it up where we can have money to buy out for these retirement plans and to have a nice retirement? Some of the needs that we're seeing here that are addressed, obviously death, again, retirement, disabilities, a big issue that's happening. As we all know, long-term care is a huge issue, and a lot of these companies need a way to keep these employees on board, and they use that through vesting schedules and also golden handcuffs. So that's what these plans can be used for. Some of the products that we can use for guaranteed issue, term insurance, we have guaranteed UL, current assumption UL, we have index, which we've had a lot of success with, and we also have VUL if you are variable licensed. That is an option as well. Some of the plan designs that we're seeing here, key man insurance, pretty straightforward. Buy-sell agreements, we're seeing this used for that. Split dollar. Half the death benefit can be owned by the employer, half the death benefit can be owned by the employee's beneficiaries. Non-qualified deferred compensation, if you're looking for any kind of write-offs, that's an option. CERT plans, supplemental executive retirement plans, very similar. And then executive bonus plans, and then REBA plans as well, restricted executive bonus arrangements. So some of these are a little bit more advanced than the others. Again, we can also always talk offline if you have questions about how these work here. So when it comes to underwriting, this is probably my favorite part of the equation. As you know, underwriting can be an absolute nightmare when it comes to life insurance. And I think that's why a lot of property casualty employee benefit firms don't want to partake in it. Well, when you're talking about guaranteed issue, it's a different equation. So in order to get guaranteed issue, you have to have 10 lives or more, which we will go over here. We do have some simplified issue programs, no blood, no urine, no exam. We have to have 3 or more lives, and then as you'll see, some of the products we're going to discuss today are very enticing for one person, for a business owner. So you can do this on one life. It's just you have to go through full underwriting. So let's talk about guaranteed issue, the questions that are asked. So really there's only one medical question here, but let's just go through some of these here. Are you actively at work for 30 or more hours per week? Are you a U.S. citizen? They do ask a smoker, non-smoker question. It just means the rates are going to be smoker and non-smoker rates. Here's really the only medical question that are asked. Have you been hospitalized for 4 or more days in the last 90 days? So, you know, we have had cases where, you know, people tend to be uninsurable and they can't get coverage, and that's not what we push here. It's not something we're looking for, but when you have enough group here, there's going to be someone that has some health issues. And unfortunately, a lot of the time, it tends to be the owners or the top people there. So guaranteed issue, when done correctly, it's truly an amazing experience, and it happens extremely fast, and that's why we're here today. So here's some of the guidelines we're looking at for permanent insurance. Again, you have to have a minimum of 10 lives to get guaranteed issue. Every person that's going to be on the plan has to make at least a minimum of $100,000 a year. This is an executive carve-out. There is a death benefit multiplier that's used. It can range from $30,000 to $50,000. Let's just say it's $50,000. You multiply that by 10 lives, you can get a maximum of $500,000 of death benefit for each person. So doing some easy math, if you have 100 people, you can get up to $5 million of death benefit, which is going to be the max that you can get. So there are some executives out there with big companies where $5 million would be incredible to have on a guaranteed issue basis. You can go down to a minimum of $100,000. Our ages range from age 18 up to age 70. Some carriers do offer guaranteed issue at a preferred rate class, which has never been done in the history of this business before. So that's very unique. And they do use unisex rates here. So in terms of term insurance on the guaranteed issue basis, I want to make sure that I disclose this. We're not talking about group term insurance. You can get that from Unum, MetLife. There's several players that have group term insurance. This is kind of something that can help to replace or add on to group term insurance, because one of the challenges with that, there's very little face amounts of group term insurance, and each person, the rate you get is really sometimes a table 4 to table 8 rating, depending on the whole class of people you have there. So with this guaranteed issue, you have to have a minimum of 25 lives. They're looking more for blue collar as opposed to white collar. Your income has to be $50,000 a year. It has the same death benefit based multiplier. The max death benefit you can get is $3 million a year, all the way down to $50,000. So you can write some smaller face amounts here and cover a larger group of people as well. Ages are very similar, 20 to 70. Unisex rates, and then this is given at a standard health class, which is kind of normal when it comes to guaranteed issue. So some of the sweet spots that we've seen here, the first thing is going to be the most important thing. Any business that's profitable is a good candidate for guaranteed issue. If you're making money, there's always an opportunity there. If you're not, then I'd say it doesn't matter which company it is, it's not going to be a good fit here. So we have had a lot of success, though, in law firms. Obviously, you have a lot of partners typically making a lot of money. Lawyers are great. They're very smart at what they do, but when it comes to planning, sometimes not so much so. CPA firms have been a great fit. Manufacturing companies, engineering firms, construction companies have been good because there's some bonding requirements that are needed, and we'll go over that in a sample case that was done, and obviously tech companies as well. So some of the needs here, some of the industries, white collar, blue collar, we've had success with. So if you were in my last webinar I talked about the importance of taxes and buckets here. So taxes for businesses are a big issue as well, and most of the time the business owner has his own personal taxes here. Just to go through this very quickly, there's 3 buckets where a lot of your business owner clients have their money. Your tax deferred bucket, your 401ks, your taxable bucket, stocks, bonds, mutual funds, and then your tax advantage bucket, Roth IRAs and muni bonds. So what happens is that this is going to show you how you're being taxed on those buckets pre-59.5 all the way up to 70.5, because everyone would have to agree. It's not how much money you make, it's how much you get to keep. So this is a really simple piece that allows you to show your client how they're going to be taxed. So pre-59.5, ordinary income tax plus 10% penalties. Tax deferred bucket becomes taxable at age 62. Too much modified adjustable gross income, 85% of Social Security benefits are taxed, and then Medicare Part B costs increase from $105 to $336 a month, and then at age 70, RMDs add to the tax exposure as well. So it's a simple piece that we have, which I'll show you at the end, that you can send to your clients. Now, some of the tax advantages of life insurance are kind of obvious here, but tax deferred growth, according to IRS code 72E1, you have your tax advantage distributions according to the IRS code 72E5C, no additional taxes for early withdrawals. There's no other vehicle that's more flexible than life insurance when it comes to pulling money out of the policies. And then obviously your income tax-free death benefit is extremely efficient as well. So what I wanted to do is go through a few case studies here. These are real cases that were done. And again, this is not for everybody. 10 lives, $100,000 a person. Not everyone's going to qualify in your book of business. But all you really need is, talk to your top 3 to 5 clients, and this could be a potential opportunity. And if one case closes, everyone is extremely happy. So we had a law firm case here. The goal was really a retirement income play. There was 25 junior and senior level partners, 100 employees total on the firm. So again, unlike group term insurance where everyone has to have the same face amount, you can discriminate here, and you can do what we call an executive carve out, and you can handpick those top people who need more than $100,000, $200,000 of term insurance. Some of the employees did have some underwriting complications when they were trying to purchase life insurance. The firm was looking to have a future cash buyout for the partners to provide retirement income, hence the retirement income play here. So just to give you a quick visual here, I'm a visual person, so here was an actual census of the company. As you can see here, ages range from 61 all the way down to 33. It does say standard non-tobacco here, but what happens is that with this carrier, they have an institutionally priced product. So what that means is that if you were to run the same 61-year-old at a preferred offer on a WinFlex, it's going to be the same exact pricing. So this was done at a preferred offer. You can see the annual premium here. And then, so we got the main gentleman got $1.5 million of permanent cash value life insurance. And if you can scroll all the way down, you'll see the death benefits lower and lower and lower down to $300,000. You can't really do this in a group term insurance plan. So you can discriminate here. We used a one-time salary approach here for income. And if we go ahead and scroll down here, get a chance to look and see. So what happens, we did a 15 pay here, so $196,838 for 15 years, so it is an overfunded contract. They did have the opportunity, if they wanted to even fund it more on a 7-pay basis. If you look to the right here, that bought $12.981 million death benefit. This particular policy was owned by the company and paid for by the company. In this scenario, a lot of the time we do see it, when it becomes the retirement income, it's company sponsored but individually owned, so there is flexibility with both options there. The goal here is retirement income, so they weren't as concerned about the cash in the early years as they were in the cash in the end years. This was used for golden handcuffs for the employees, vesting schedules, stay with us for 10, 15, 20 years. They have the ability, if they want to gift that policy down the road, if they wanted to that employee. Now, obviously, upon that happening, there would be some type of taxes for the gain, so you could speak to your attorney about your CPA about how that would work. So this is the retirement income play. It was a great case. It made a lot of sense for the client, and yes, so that's the retirement income play for a law firm. So our next case here we're going to look at, it's called a balance sheet play, and you'll see why in a second here. So we had a mid-sized construction company. Their whole goal was to keep liquid assets on the books to cover some of their major bonding requirements. When they do they do some big skyscrapers, so they have to keep a ton of money on the books. And we all know when you have money on the bank account, what is the earning? If you're lucky, 25 bips. If you're lucky, so a lot of the time they're not earning anything in the bank account. There was no current buyout plan in place. There was 15 key employees that did qualify for the plan. They had over 100 employees total. The CFO's main concern was keeping money on the balance sheet, which is always their concern. And so in the past, when you have a conversation about doing life insurance, sometimes you get the door slammed in your face because of that hit you take year one. You put in $100,000, you might have $50,000, $60,000 of cash in the policy. So what we did here is the company purchased a 7-pay universal life overfunded policy for the 15 employees. And the key thing you're going to see here is that the cash value was more than 100% year one. And I'm going to go ahead and give you a visual here. So again, here's the census of the group, ages ranging from 62 down to age 40. This was a key man policy, so all of our death benefits were the same, $443,000 for each person across the board. This was company owned because of the key man part of the equation. If someone does pass away while this policy is being funded, or even after, the employer death benefit would go to the employer, and at that time they can do whatever they want with it. If they want to set something up, a vesting schedule for the golden handcuffs, they can as well. So let's go ahead and look at the illustration here. 15 people were on the plan. So what we did here is, again, this is a 7-pay concept. So we put in $410,000 a year for 7 years. If you look over that, what, $6.6 million of death benefit for the employer. And then here's where it gets interesting. So the accumulation value is $336,205. But if you look over here, the cash surrender value is $415,000. Wait a minute. How can that be more than what's put into the policy here? So normally with life insurance, here's the hit you take for your cost of insurance charges. But what happens here is this specific carrier has a product which is called a COLI enhancement. And what that means is that the difference between the 336 and the 415, the carrier puts out of their own pocket. Because in the past, the CFO would slam the door in the face and say, this is not going to happen here. Well, this is why this enhancement was created, to make sure that the company could be positive with their cash flow. This is a 12-year enhancement. So if you look down here at year 12, these will equal. This is called a COLI enhancement. Now, all of a sudden, when you have that same conversation with the CFO, this is a balance sheet play now. So you're not asking him to part ways with his money. His money is sitting here in the policy. But right now, he might have money in the bank account earning nothing. So, excuse me here. So the whole purpose here is you're not telling him to part ways with his money. It's just moving it from one pocket to another pocket. And now this is an asset on the balance sheet, and this does cover the bonding requirements as well. So construction companies, we've done our due diligence there, and this because, as you know, life insurance, after year one, you can pull money out of this policy as you please. Doesn't always make sense in your funding years, but you do have access to this cash here. And if you look here, after the 7 years, they wanted to start drawing money out for retirement income for some of their key people. So as you'll see income coming out of the policy. And this is the balance sheet play. You can do this for one person. You just have to go through full underwriting, so it is an opportunity out there. Now, everyone says this sounds a little too good to be true here. What's the catch? Well, for the business owner, there is no catch for them. If they want to, after year one, they can take their money and they can run, and they'll be positive. The person this has an effect on is the agent and the general agency. So what I mean by that is, what the first thing they do is there's a 4-year chargeback on this product to protect themselves. So it's a reducing chargeback year one, 100%, year two, 75% down from there, and they also reduce the compensation down. So, but you are paid on the 7-pay premium. So it ends up evening itself out. tremendous opportunities in the COLI space with this enhancement. I'd love the chance to talk to anyone about maybe looking at a policy to talk about here. So one more scenario to talk about here is a term insurance option. I think it's important to show you a little bit of everything here. So the term insurance scenario, we had a doctor group with 63 doctors. The group had no coverage for revenue loss in case someone did die. So what we did here is we set up a key man policy to make this is a real simple scenario. $1 million of coverage for each person. They set it up in the beginning for the owner, and the beneficiary was the employer. But the cool thing about these term policies is that the policies can be all individually owned, they're portable, and they're convertible. So they can gift those policies to each doctor, and they don't have to worry about with normal group term insurance. At a certain age, if you're not there with the company anymore, you lose the policy. These policies are going to be owned from that individual, paid for by the company, and it's up to them how they want to charge each individual doctor on the group there. Term insurance, typically what we do is we do a lot of replacements when it comes to group term insurance. So this is a good scenario. We can discuss this. We can go over it. Remember, term insurance, it's a lower face amount needed. You can go down to $50,000, and you don't need as many, and also the standard offer there. So that's the group term insurance play. So what do we need to get started here? What's the next step? So all we need from you is a census, and on that census, we just need a name, we need a date of birth, we need an annual income for each person that's going to be on the plan, and then we need a job title. Again, you can discriminate with these plans here, but you have to realize whoever you put on the plan, it's going to have to accept it. So if there's 100 employees in the firm, you don't have to send us all 100. Maybe you send us the top 20, but those 100 people do have to accept the plan. So that part of the equation is not voluntary for the 20 people there. So most GAs we have good concepts, but then once it comes to how do you market this to your book of business, that's where we can fall short. Well, what I want to do is go over 3 different options here. So we have a business insurance questionnaire we're going to go over. We're going to go over the complimentary business valuation, and we're going to go over a tax-free retirement piece that can help you to talk to your current and future book of business. So first we have the business insurance questionnaire. We put this together over a long time, just kind of filling the needs of some questions that could be asked to your business to figure out where the needs are and where the holes are in terms of their insurance. So I'm not going to go through this whole thing here, but just a few of the points to recommend to show you is that it's always important to know what the tax entity of the company you're working with is. Is there any kind of buyout plan in place for partners for retirement? How would the buyout plan work if someone was to die, to retire, to become disabled? So if they have a written plan in place, it's always good to try to review that plan. So again, there's some really good questions in here of things that you can ask your client to make life easy for you and to see where some of the needs are. If you look at the top here, you'll see that this piece can be branded with all of your information. We're not here to market ourselves. We work for you. And our job is really to brand you and to get you what you need so you can have success in this space here. All right, so then we have the complimentary business valuation. I'd say out of all the pieces, this one is extremely powerful. So by working with BackNine Insurance, you have the ability to offer all of your current and future business owner clients a complimentary business valuation. Now, this can range from thousands to tens to hundreds of thousands of dollars, depending about the size of your company, and you're bringing a huge value to them without having to go in there and ask them about life insurance. You're giving something away for free. It's always easier to get someone to give you something if you give them something first. And again, there's a real big cost involved here, but you're able to do it now complimentary with no cost to you or to your client. It generally takes about 5 to 8 business days to come back. With some of these valuations, you have to be careful because they offer you one method and there's really 5 methods to talk about. So that doesn't really help out your client. With this valuation, they give you 5 different methods. You have your book value method, your straight capitalization method, earnings capitalization, years purchased, and discounted future earnings. When this 40% of the time after this valuation is done, some type of insurance is sold, whether it be life insurance, whether it be disability income, long-term care. So it's a tremendous opportunity. Again, we can brand all your information here. The bottom of the piece shows what's needed to get this done. So it's just a 2-pager. We can have all your information on here. The most important thing that's needed, is 3 years of tax returns or 3 years of business financials. Once that information comes back, you're going to see a lot of opportunities of where this can be a success here for you. I do have even more marketing pieces on this if you want, so ask me after the seminar about reasons why would I need to do a business valuation. I'm not planning on selling my business. So I do have some Q&A on that for questions that can help you out to overcome any kind of objections that you might be seeing there. So please do not hesitate to send me an email, give me a call after, and we can discuss that. If you didn't, this is probably the most important piece that you'll see today. If you can offer something complimentary to your clients, especially the clients that you're in good relationship with, they'll love you for it. You're saving them money here. Now, this is an informal valuation, so it would not hold up in court. But besides that, it's extremely accurate, and all the research is done here. There are attorneys that are doing this, so it is extremely accurate here. So that is the business valuation complimentary that you can use there. Last marketing piece that we have here, which I did on my last webinar. So here's the piece regarding taxes and the power of cash value life insurance, and also the power of that fourth bucket, which is that non-reportable tax-free income. Again, we can brand all of your information here. This piece, just to run through this, goes over all the increases in taxes that have happened as of late. Always, what better way to get someone's attention to talk about taxes? It shows the 3 buckets where your money is currently right now. Again, it shows how you're being taxed on that money, pre-59.5 all the way up to 70.5. And then it talks about the fourth bucket that can create that non-reportable tax-free income, which is life insurance. And then it talks about some of the benefits here and some of the tax codes that we talked about as well. Life insurance is not the sexiest thing. People don't buy it because of that. They buy it because of the benefits that it provides. And with all the business stuff we're talking about here, that life insurance, it comes out tax, it comes out, it grows tax deferred and comes out tax free. People always question when you say tax free. Well, just a little quick explanation about how that actually works here. So if you put $100,000 into a life insurance policy, you're able to pull out $100,000, which is up to your basis, without any taxes, and that comes out via a withdrawal. Well, the next dollar that comes out of that policy, what happens is that you switch over to a loan now, and now you become your own bank. So that carrier might charge you 2 or 3% on that life insurance, on that loan, but what happens is they turn around and credit you that same 2 or 3%. So it ends up being a wash loan. So that's hence becoming your own bank. And as long as you die with this policy, you're not going to get charged for the gains there, taxed on the gains. Most of the carriers today have built-in riders, overloan protection riders that allow you to, so no matter what happens, you won't be able to pull. Once it gets up to that level where the policy is going to die, it shuts off and automatically turns into a paid-up policy. So that's the power of life insurance. So when you close one of these large cases, you're going to have a lot of people that you have to, there's a lot of people that you have to keep track of and keep organized. So what we did is, it took about 5 years, but we created something called the producer's place. And what this is it's a one universal place you can log into to track all of your cases and all of your business. So as you see here, we have live case status updates on here. It tracks all your in-force and pending business. You can view all of your commissions on here to see what you're getting paid on cases. You can view all your appointments with the carriers. In-force data feeds we have right now from 5 companies. I can guarantee you that this has never been done in the history of this business. So you can see up-to-date beneficiary information. You can see up-to-date cash flow, what's in that policy. This is truly a game changer for us, and we're extremely excited about it. So if you have any questions, please talk to me after. You have access to all your documents. You can see the application right there. You can see where we're at in the case. You can actually chat live with your case manager via a text message right to your case manager. So this system here is, we actually have a developer in our office. That's all he does all day long is work on this program here. So we're really excited about that. Technology is extremely important to us here at BackNine Insurance, and our goal is really to stay ahead of the competition and revolutionize what we're doing here. So if you have any questions about the portal, I'd 100% recommend going to our website. You can register for a free account. You can play with it and try it out and see how you like it. Last thing I want to show you here is this is a picture of the actual law firm case that was closed here. And as you see, that smile on my face is what it looks like when you get 25 people through underwriting on a guaranteed issue chassis off of one question. This was a $268,000 case. That's 25 policies there. The agent's smile was bigger than mine because we put about $250,000 of commissions into his pocket off the record. So I just want to give you a visual here. These cases are not for everybody, but when they do happen, they are 100% sweet. All my contact information is here. If you have any questions, please give me a call. You can send me an email. And just so you know, everyone who attended the webinar will be receiving a copy of the whole webinar, as well as all the marketing material that we discussed during the meeting here will be sent off to you. So I greatly appreciate everyone's time and taking it out of your busy day, and I'm hoping that we can get some cases going here. Thank you so much for your time, and have a blessed day.